Good morning, and thank you for joining us today. This is Tara Sewell, Internal Wholesaler. Today is our FMI Agent Fall giveaway, and we also welcome a guest speaker from MassMutual. Your lines are muted for sound quality. If you have questions, please reach out to your internal wholesaler after the call. We can't begin without a thank you to our advisors on the call. Together, we're creating a lasting impact, safeguarding families, building secure financial futures, and honoring legacies. Thank you for your partnership and thank you for your business. Congratulations to Cliff. He was our summer giveaway winner, and our runners up each received a $50 gift card. Thank you for your business. Feeling lucky? We have dropped 4,618 tickets in our hat, and they've been shuffling. One advisor on the call will have their choice between a locking gun safe or a PlayStation 5 or MetaQuest virtual reality headset. 4 runners up will each receive a $50 Amazon gift card. In order to win, you must have earned tickets, be pre-registered with your full name, and be present on the webinar for the duration. Your name can only be drawn once. Before we draw our finalists, I would like to introduce our guest speaker, Randy Zipse. Randy is the Advanced Sales Lead for MassMutual Strategic Distributors. He brings over 30 years of experience in the life insurance industry. Randy is nationally recognized expert in trust taxation, estate planning, and business succession planning. Prior to entering life insurance, he was a private practice attorney and worked as a CPA. Today, Randy joins us to discuss planning with permanent life insurance. Randy?
Thank you very much. I really appreciate everybody taking time out of their day. I know the real draw here is to win Tara's prize, but I'm still very glad that you would take some time to spend with me this afternoon. What I'm going to talk about are some of the sales concepts that I'm having some success with. As Tara said, I've been doing this a very long time, 31 years, but I'm only 4 years at Mass, so I'm getting myself a little bit back in the swing of whole life. I've really sold all kinds of life insurance over the years, everything from IUL to VUL to guaranteed universal life to current assumption, really the whole spectrum. And whole life is kind of new for me, so I thought I would spend 20 minutes or so talking about where I'm having some success. Hopefully you have some of the same sorts of opportunities in front of you. I'd be happy to work with you on them. So let's kind of go through here. Hopefully the technology will work for me, but God knows. All right, here's what we're going to talk about, just kind of from 30,000 feet. Probably what I end up spending more time with than anything else really isn't in a lot of ways what I would call a quote sales concept, if you will, but simply whole life as a non-correlated asset. Mass sells a lot. I get involved in a lot of, and some of the cases are huge. Probably some of the biggest cases that I work on are simply life insurance as a non-correlated asset. I mean, if you think about it, the underlying investment on a whole life contract is largely what? It's largely bonds. So a lot of investors are purchasing life insurance to shift a lot of that investment risk into life insurance, and whole life really is the one that provides the best risk shifting, not just from a mortality standpoint, but from an investment standpoint. So we are selling a lot of whole life, if you will, as an investment, specifically as a fixed income investment. And a lot of times that's being correlated with some kind of a retirement sale, whether that's a supplemental variable policy, a supplemental IUL, whether it's just somebody buying whole life to take distributions from when they're in retirement rather than a 401k because there's a down year. The worst thing you want to do, of course, right, is take a withdrawal from your 401k after a year where the market's taken a 20% hit. So people are buying whole life as a non-correlated asset for sequencing of returns. As an estate planning concepts, And that's really, my background is I'm an estate planning lawyer, have a lot of experience with business owners. From an estate planning standpoint, we see our whole life products used a lot in slats. Hopefully everybody on the call knows what a slat is, but a slat is simply a spousal life access trust where a married individual is creating a trust with his or her spouse as a beneficiary, and that spouse can get access to policy cash values during lifetime. I'll talk about why whole life is a good funding tool for those, but the conservative predictability, non-correlated aspect of whole life lends itself well to slats, and we do a lot of that both individually and seconded I. I get involved in some large case work with our Whole Life 100 contract. That contract will have an increasing face amount. The cash values are such that they push the death benefit up. And so with clients who believe that their estate is going to increase over life, sometimes like to have their death benefit product increasing as well. And some of the offerings that we use offer in the whole life area work well when you need an increasing face. Again, flexibility. We don't know what the estate tax is going to look like when we die. Today's politicians can say that this is a permanent tax bill, that the one big beautiful bill is a permanent tax bill. The one thing the one big beautiful bill isn't is a permanent tax bill. There is not such a thing. It's permanent until the next time there is an opportunity in Washington by the other party to change the priorities. So the one big beautiful bill is permanent until it's changed. I'm 62 years old. My life expectancy is roughly 25 years, which means that I'm going to, on average, maybe more, maybe less, right? But on average, that's 6 presidential elections that I have yet during my lifetime if I lived a life expectancy. So do I really believe the estate tax, what it is today, is going to be the same when I die 6 presidential elections from now? I think that's a long shot. So cash value life insurance, especially predictable cash value life insurance, where I'm providing for my death benefit that I need now today, but also allowing for cash values in case I live past my retirement funding, or in case at some point in time there is no estate tax at all. It could go away, right? But the flexibility that whole life brings for the unknown future of both the estate and the income tax is a pretty important thing. And a lot of people like the flexibility and the multiple benefits that whole life bring for the cash as well as the death benefit. I do a lot of business insurance. I started in the life insurance business as a corporate-owned life insurance guy. I ran a Foley group. So I still get involved a lot in life insurance funding for non-qualified deferred comps, whether that's a SERP, whether it's a simple 162 plan. I do a lot of life insurance in buy-sell situations. We do key person life insurance. If you're have clients who are in businesses where they have to post bond, think about construction, think about architects, think about engineers, trucking companies that have to have cash bonds. They're holding a lot of cash assets. We move a lot of those cash assets into high early cash value whole life insurance. For those bonding companies will accept those cash values from those whole life policies that Mass issued just the same as they would accept cash in a bank. So the returns oftentimes are much more competitive on that whole life portfolio than they would be if that cash was just sitting in a bank account somewhere. So with business owners that have to bond, we see a lot of that cash being moved over to whole life, and it's being used, to post the bonds that those companies have to do. So that's kind of what we're going to talk about. I'll go down a little bit more each of those here over the next 15 or so, but that's, at 30,000 feet, that's largely where I spend my time. Sequencing of returns, you know, as I already talked about a little bit in the summation, sequencing of returns is huge, right? It really doesn't matter nearly as much what the average return on your investment is in retirement as it matters what the timing of the up and down years in your retirement are. When you reach retirement and you're starting to pull dollars out of your 401k, or you're pulling dollars out of a variable life insurance contract, if you're using one of those kinds of assets and you just went through a down year, the stock market dropped 10%, the market dropped 20%, God help us if we have a year that's even worse than that, which certainly is possible. Do you want to take withdrawals from those equity portfolios the year after that market had the correction? Of course not, right? Because we all know that eventually the markets will correct. They always correct. They always have, probably always will, right? But for a year or two, those markets are going to go up, get back to where they were. And so having a whole life insurance contract to protect, so you can take withdrawals from that whole life policy in those down years, is really a huge benefit to the certainty that you can offer your clients in retirement. Think about it on average. Probably if I retire at 70, how long am I going to live? 15, 20 years, right? In 15 or 20 years of retirement, I'm probably going to have 3, 4, 5 down years. So what you're looking at is purchasing enough whole life that when you get to that retirement age, you can pull cash value out in that 2, 3, 4 years that the market is down, so you don't have to touch your other investment assets in those years. And that's what whole life is used for a lot. Like I said, it might be the single biggest use that I see for our products. SLATs. What's a SLAT? Spousal Life Access Trust. As I said, it's an irrevocable trust. It's just Randy is creating an irrevocable trust. And it's going to be for my spouse. My spouse is a permissible beneficiary of that trust. But it's also for my kids, right? So it's just a basic trust. It's going to say, while Randy is alive, his spouse can take distributions from that trust for her health, education, maintenance, and support. And when Randy passes away, I can either have that stay in trust, which is what I want, right, from an estate tax standpoint. So it's going to say it's going to stay in trust, and then it's going to end when my spouse dies and go out to our kids or our grandkids. But the idea is my spouse is going to have access to those policy cash values during her entire lifetime. It's out of my estate. I can draft it in a way that's out of her estate by simply having it only subject to health, education, maintenance, and support. It's out of both of our estate. It's creditor exempt. Creditors can't get that. My creditors can't get it. Her creditors can't get it. And again, it's out of both of our estates. So SLATs are a very, very popular planning tool. In fact, it's how I do most of my irrevocable life insurance trust planning. When I get involved in the planning process myself for my clients or your clients, typically I'm going to use a SLAT, and it's flexible, right? It's out of the estate, but one of the spouses has access. You can do that with a second to die contract as well. And whole life makes a lot of sense because, again, it's out of the estate. It's creditor exempt. It's going to be the last asset that family should ever access, right? My spouse and I are creating this SLAT, and we want to keep access to the policy cash values, but we're not going to use it unless we exhaust our other assets first. So from a risk perspective, that SLAT should be the most conservative asset that I probably own because it's going to be the last asset that I'm going to touch. So a whole life insurance contract is really in a lot of ways the ideal product for funding that SLAT. And we do a lot of SLAT work. And predictable, non-correlated to the client's other retirement assets. the certainty of the death benefit, I know when I die that death benefit is going to be there. And there's no income tax on the policy cash values or the death benefit when it's paid. So it's predictable, it's non-correlated, it's got certainty, and it's tax efficient. It doesn't matter what the estate tax is today. I mean, I've already talked about that, right? It really doesn't. Although you have to plan for what it is now because it's our best guess. But is it really permanent? Come on, it's not permanent. It's not going to be. There's budget increases, deficits every year. You know, and none of the parties have seemingly been able to reverse that trend, right? I shouldn't say none of, since there are only two in our country. Neither of the parties have been able to stop that trend. The budget deficits just increase. At some point in time, somebody's going to have to raise taxes, right? Cutting spending is one part of it, but raising taxes is going to have to happen eventually. So I don't know where the estate tax is going to go, but at my age, you've got 6 presidential election cycles to go through. So, you know, can your client really have too much life insurance, I guess, is the answer to that question. And I don't think so. I've paid a lot of death claims myself. I've sold a fair amount of life insurance myself. I've paid death claims, I've paid death claims to the spouses of some of my best friends, sadly. 2 of my best friends, I've handed a check personally to their wives. You know, the first time you hand that death claim over, that check over to, you know, to one of your clients, a spouse of your client, the children of your client, that's a life-changing event. And I've never had somebody say, oh man, that's way too much. I can't believe dad bought that much, or I can't believe my husband or my wife bought that much insurance. Doesn't happen. So it's better safe than sorry. Life insurance is a great product. It's a great legacy, and should be something that you're proud to sell and offer. Business insurance. Like I said, I do a lot of business insurance. Hopefully, you guys all understand when you're working with clients that have C Corps, what the excess accumulated earnings rules are, because I'm not going to lie, even some accountants don't understand what the excess accumulated earnings tax is. But you're not allowed to leave an unlimited amount of earnings into a C Corp. C Corps have a taxation of 21% flat rate. Most of your individual clients are paying taxes at a rate much higher than that, probably 37% without even considering state taxes. So there's an incentive or a motivation to leave money in C corporations because it's taxed at a lower rate. The IRS doesn't want that, so they force you to push that out either through compensation or as a dividend. If you're going to retain more than $250,000, you need to have a reason for retaining it. One of the reasons that you can state and you can retain earnings for is key person life insurance. So a lot of C Corps are buying whole life simply to avoid the accumulated earnings tax, holding it as key person insurance. I already talked at length about bonding. Now, if you have construction firms, you know, firms like that that have to put up cash bonds, it's such an easy sale, honestly. The Mass whole life contract pays a dividend of 6.4. That's our dividend rate. By the time you take cost of insurance and other loads out of it, it's still probably, depending on the client, has a cash on cash growth of between 4 and 4.5. That 4 to 4.5 is probably consistent, maybe even beating what your clients are earning on their bank accounts for the cash they're holding. So their cash on cash is going to grow similarly to their bank accounts, plus they're getting the life insurance protection. So bonding is, companies that bond key person life insurance is a fairly easy sale and a good one. Small case non-qualified deferred comp. I do a lot of it. 162 plan. What's a 162 plan? It's simple. Tara is my key person. My business would go to heck if I didn't have her. She's amazing. So what can I do? you know what, I'm going to do a 162 plan for her. It's very simple. She's going to be the owner and the beneficiary of a permanent life insurance contract, and me as the employer, I'm going to pay for it. That's all 162 is. Now she has a source of supplemental retirement income. She's got a death benefit to protect her family. So 162 plans are a very simple non-qualified deferred compensation strategy, and whole life, because of the predictability, because of the ability to assume and meet the growth of those policy cash values. The performance is not as erratic as a lot of other life insurance contracts that are out there. 162 works well for whole life. A restrictive endorsement bonus arrangement is simply a 162 plan with some kind of restriction. Again, my key employee is going to own the policy on his or her life, but me as the employer, I'm going to put a restriction on it. Maybe I'm going to say my key employee can't access policy cash values until they reach retirement age, unless I sell the business earlier or something like that. But I want to be sure that my employer isn't leaving and taking the life insurance policy along. I want to try to retain them. So I'm using a restriction on my 162 plan. That's what a restrictive endorsement bonus arrangement, or a REBA, is. A SERP, Supplemental Executive Retirement Plan, which is just your traditional non-qualified deferred comp. A SERP simply is, I'm promising my key person or key people something in retirement. If Tara stays around until retirement age, I'm going to pay her 50% of her final salary for 10 years. That's a SERP, an example of a SERP. Oftentimes, life insurance is how you fund those SERPs. That life insurance is owned by the business. Whole life is a good way to fund that, again, because of the predictable cash and death benefit that it provides. Oftentimes in that format, you're going to use an early cash value type of a policy. Mass has policies that are for business ownership, where the policy cash values can be greater than 80 and into the 90% in the early years of those policies, so that the business isn't funding them and taking a big hit to earnings in the early years. We provide accelerated cash values in the first few years to keep on the business's books. Split dollar plans are probably above what I'm going to talk about in 25 minutes, but the executive owns the policy. It's usually paid for by a business loan. The policy is going to grow and mature at a rate hopefully higher than the interest rate on the loan. So split dollar can be a good way to push value to an employee on a very tax efficient, if not tax-free basis. We also do a lot of tax exempts. There is an excise tax for earnings over $1 million. Doctors and coaches are the places where this oftentimes comes into play. High income earning people at tax exempt organizations. Also, privacy. Charities have to file public returns that show how much compensation their key people gets. If you are a charity in Rapid City, South Dakota, and you're out soliciting around town, you probably don't want everybody in town to know how much your compensation is, right? Privacy. So split dollar is a way to pay what's effectively compensation to executives without having to disclose it in the disclosure requirements. Buy-sell planning. Just do so much buy-sell planning. Permanent life insurance, and by the way, disability insurance are so important, because it's way more likely that somebody's going to sell a business during life, or they're going to become disabled. Term insurance is not the way to fund buy-sell planning. So we do a ton of buy-sell. There was also a recent court case called the Connolly case that, if you haven't been talking to your business owners about buy-sell planning, you really need to. And if you don't understand what Connolly is, I encourage you to reach out to me, and I will give you a discussion about what Connolly is. Or Tara can set up another Zoom one day, and I'll talk about Connolly. But Connolly is important for how you structure your clients' buy-sells. For any client that may have an estate tax problem, you don't want to have the buy-sell funded at the business level. The life insurance is going to increase the value of the business, potentially driving up the valuation and driving up the estate tax exposure of the client. So because of Connolly structuring buy-sells correctly as some sort of cross purchase as opposed to an entity arrangement is super, super key. So that's one of the things that I spend a whole lot of time on is buy-sell planning. Well, Tara, that is 25 minutes. I'll leave you 5 if somebody's got a question, but I promised to hold it to that, and I think I got through what I had to.
Thank you, Randy. Let me get this switched over again. Thank you, Randy. A lot of information, a lot of great content, and like you said, it is a short amount of time to really go very far into detail. So, folks, if you have questions about any of those concepts, reach out to your internal wholesaler. Randy, we are grateful for your expertise and this knowledge that you've shared with us today. I'm sure we will have many follow-up questions. Here's a question for our advisors on the call. Did you know that MassMutual has paid dividends to their participating policy owners since 1869? Wow, that's quite a history, consistency. Reach out to us today if you have a case you'd like to discuss, or maybe one of these concepts that you'd like more information on. Again, thank you, Randy, for your time today.
Thank you.
Now let's move on to our drawing and draw our first 2 finalists. Pull up my hat here and give it one last shuffle and drop them in our hat. And we're looking for our first finalist. Art Archidiacono. Is Art on the call, Neil?
Tara, Art is on the call.
Congratulations, Art. You are our first finalist. And now our second finalist, Heather Adajar. Is Heather on the call?
Just looking here, Tara. Heather is on the call.
Congratulations, Heather. You are our second finalist. Last week, you should have received your October business opportunity report from your internal wholesaler. We're pleased to partner with Proformex to deliver this valuable monthly resource. This provides in-force data from 20 of our carrier partners. This report is designed to support your annual policy review planning by identifying key opportunities within your existing book of business. This report highlights important details such as upcoming client birthdays, policy anniversaries, expiring conversion options, premiums due soon, and potential life settlement opportunities. Let's move on to our next 2 finalists. Ross Bauer with 59 tickets. Is Ross on the call?
Taking a look here, Tara. Ross is not on the call.
Okay, folks, you do have to be on the call in order to qualify. So we're looking for our third finalist. Jean Olson with 12 tickets in the hat. Is Jean on the call today?
You take a look here. Jean is not on the call.
Okay, we are looking for our third finalist. Jacob McCullum with 14 tickets. Is Jacob on the call?
And Jacob is on the call.
Congratulations, Jacob. You are our third finalist. We're looking for a fourth finalist. Bradley Olschlager with 105 tickets. Is Bradley on the call?
And Brad is on the call.
Congratulations, Brad. So just to recap, we have Art Archidiacono, Heather Adajar, Jacob McCullum, and Bradley Olschlager as our finalists so far. We are paying it forward. In addition to your normal compensation for all annuity, life, disability income, and long-term care policies written from September 1st through November 30th, you can earn an additional $100 prepaid credit card per paid policy. So for all business paid by November 30th, you'll receive a $50 for each paid policy and a $50 bonus for each policy that was paid and submitted through eApp. There's no limit. So eApp is available to you through our website, fmiAgent.com. Life eApps are submitted through iPipeline, and annuity eApps are available through Firelight. Contact your internal wholesaler. We'd love to help you streamline your life and annuity sales. And now, our fifth finalist. Eric Tingey with 530 tickets. Is Eric on the call?
And Eric is on the call.
Congratulations. So our finalists today, Archie Diacono, Heather Adajar, Jacob McCollum, Bradley Alschlager, and Eric Tingey. While Neil sends that over to me, he's going to tell us a little more about our upcoming cruise.
Well, congratulations to those 5 finalists, and very, very good talk earlier. Good ideas to reach out to your internal wholesaler to discuss a potential case or two. The bonding requirement was one that kind of caught my eye, and that might be a good opportunity for some of you on the call here. But with as little as $1 million of annuity production or 30,000 of life production or any combination, you and your guest could be on your way to the next amazing FMI Agent Point Awards trip. Hey, join us for an unforgettable cruise up the Pacific coast aboard the magnificent Royal Caribbean Serenade of the Seas. This will be Tuesday, May 5th of 2026 through Sunday, May 10th. Immerse yourself in the natural beauty of the Pacific coast while enjoying gourmet cuisine or relaxing by the pool. We'll set sail from vibrant Los Angeles, visit Seattle's Space Needle for a 360 view of the city, explore historic landmarks in Victoria, British Columbia, and enjoy the picturesque Bouchard Gardens in Vancouver. Hey, we all here at Financial Markets look forward to helping you throughout this year to get you qualified. Thank you for your business and good luck to the potential winners here.
Thank you, Neil. So mark your calendars. The Christmas giveaway has officially begun. For every application you submit between October 6th and December 5th, you will earn tickets for our live drawing on December 11th. You'll receive 1 ticket for every application submitted with our premier carriers and double tickets for business submitted with the premier carriers. Triple tickets for any business that is placed by December 5th. So mark your calendars for Thursday, December 11th at 10:30 Central. We'll be drawing for a $500 Amazon gift card. Now let's draw our fall winner. And bring our hat up here. Give it one last shuffle. And draw our winner for today. Jacob McCollum. Congratulations, Jacob. We will contact you for your choice of a PlayStation 5 or MetaQuest 3 or a locking gun safe. And congratulations to our runners-up. You will each receive a $50 Amazon gift card. Thank you for spending time with us today. We appreciate your trust and your business, and we're honored to share this journey with you, helping families and creating lasting legacies. From the team at Financial Markets, have a beautiful day.